A direct strike on Iran could trigger a parabolic spike in gold and oil almost instantly, while high-income earners are already signaling a recession by flooding the aisles of Walmart.
Former Fed insider Joseph Wang and billionaire financier Frank Giustra warn that we are entering a period of extreme volatility where the dollar is no longer king.
We have used advanced AI to compress hours of deep dive research from Wang, Giustra, Jeff Snider, and Andy Schectman into a single high-speed briefing.
From the $10 silver premium in China to the one massive pivot point on Wednesday that will decide the fate of the S&P 500, you cannot afford to miss this.
Welcome to our breakdown of the February 21st, 2026 episode of Markets Weekly.
In this update, Joseph Wang analyzes a massive legal shift regarding presidential tariff powers and warns of a possible conflict in the Middle East.
It sounds like a busy week for the markets. Does he also cover the latest economic data?
He does, including some surprising GDP numbers and the latest signals from the Fed and the ECB.
Despite the Supreme Court ruling against the use of emergency powers for tariffs, Joseph Wang argues that the tariff wall is here to stay.
He expects the administration to simply shift legal grounds, moving from AIPA to Section 122 and eventually Section 301.
So the market shouldn't expect those trade barriers to actually disappear.
Not at all. Joseph sees this as a new, permanent trade policy for the United States, regardless of the legal hurdles or which party is in power.
The big news on Friday was the Supreme Court ruling that the president cannot impose tariffs under emergency powers.
While the president can declare an emergency for things like embargoes, the court held that taxation remains a power of Congress.
But didn't the president respond almost immediately?
Yes, by announcing new global tariffs of 10% under Section 122, which were raised to 15% just a day later. Economic data showed that GDP was weaker than expected, largely because of a government shutdown that lasted several weeks.
Inflation is still hovering just below 3%, and interestingly, some Fed officials are still talking about the possibility of rate hikes.
That seems strange if the economy is slowing down.
Joseph agrees. He thinks the talk of hiking rates is ridiculous given the upward trend in unemployment and the downward trend in inflation.
Over in Europe, Joseph highlights reports that ECB President Lagarde might resign before her term expires.
The goal would be to allow President Macron to appoint a successor before populist parties gain more influence.
It sounds like they are playing the same political games we see with the US Supreme Court.
It is exactly that. It shows how worried they are about political changes impacting monetary policy in the Eurozone.
Joseph predicts that a major conflict with Iran is very likely in the coming days.
With another carrier group moving into position and significant Air Force assets deployed, an operation could happen as early as this weekend.
What would that do to the broader market?
It would likely be a major risk-off event, causing a flight to safety that would dominate the headlines and market sentiment. While the AIPA tariffs were ruled illegal, don't expect the hundreds of billions collected to be returned quickly.
The litigation will be incredibly messy because it is hard to track if importers or consumers actually bore the cost.
So companies won't be getting that money back anytime soon.
Joseph expects the revenue to remain stuck in the court system for a few years at the very least.
To wrap up, Joseph Wang advises staying focused on the potential conflict in the Middle East as the primary market driver.
Between geopolitical risks and the shifting legal landscape for tariffs, we are entering a very uncertain period.
So, keep an eye on the news and stay cautious.
Exactly. Thanks for joining us for this analysis of the latest from Joseph Wang. If Israel strikes Iran, we are looking at a parabolic spike in gold and oil. That is the warning from billionaire financier Frank Giustra.
Frank Giustra told David Lin that the market is completely underestimating the chance of a massive regional war.
Wait, parabolic? Like straight up? My gas price is already high enough.
Exactly. Frank says we're talking about oil hitting $100 a barrel almost instantly.
Frank Giustra isn't just a mining guy. He's obsessed with how $34 trillion in debt forces countries into conflict.
Wait, 34 trillion. Is that even a real number anymore? How do we even pay that back?
Frank's take is that we don't. He suggests war often becomes the ultimate distraction when the math stops working.
While gold looks like a winner here, David Lin's discussion reveals a massive trap for the US dollar that will break down in a minute. Frank Giustra argues that the war premium isn't priced into markets yet.
He believes a direct hit on Iran's oil infrastructure would send crude past $100 per barrel.
Hold on, $100? That's going to make everything from groceries to shipping way more expensive, right?
It's a massive inflationary shock. Frank says gold would be the only safe place to hide.
According to Frank, gold isn't just an investment anymore. It's insurance against a system that's running out of road.
Insurance? Like in case the whole stock market pulls a disappearing act?
Pretty much. Frank Giustra highlights that gold has no counterparty risk. It's nobody else's liability.
And with $34 trillion in debt, that liability list is getting pretty long. Frank Giustra points out that with 34 trillion in debt, the Fed is basically trapped.
Right? If they raise rates to fight inflation from high oil prices, they bankrupt the government on interest payments.
Wait, so if they fix one problem, they literally blow up the other. That's a terrible choice.
It's a mathematical dead end. Frank tells David Lin that soft landings are just fairy tales at this point.
Frank notes that central banks in China and the Middle East are dumping treasuries and buying record amounts of gold.
If the big banks are ditching the dollar for gold, should I be doing the same thing?
They bought over 1,000 tons last year. They aren't doing that for fun. They're de-risking.
Frank says this is the start of a new world order for currencies where the dollar is no longer king. This is the dark part. Frank Giustra suggests that when economies fail, governments often turn to war to reset the clock.
It's a historical pattern. You print money for the war effort, inflate away the old debt, and blame the conflict for the high prices.
So they use war as an excuse for why my coffee costs $10. That's incredibly cynical.
It's a great reset through fire, as Frank describes it.
Frank Giustra predicts gold will go parabolic if the Iran conflict escalates, easily clearing $3,000.
$3,000? It's never been that high. Is he serious?
He's very serious. He notes that gold is currently in a silent bull market driven by Eastern nations, not Western retail investors.
When the West finally wakes up and FOMO kicks in, that's when the price vertical happens.
Frank also warns that oil volatility will crush the stock market. High energy prices act like a massive tax on every business.
So my tech stocks are going to tank because oil is too expensive.
Exactly. Profit margins vanish when it costs twice as much to keep the lights on and ship products.
Frank believes the next few months could be the most volatile we have seen in decades.
Frank Giustra's main advice is to hold physical gold and high-quality gold miners as a hedge.
He likes miners because they offer leverage to the gold price, but warns they are risky if oil costs stay too high.
Wait, so I should buy the gold first and maybe the miners second?
Physical gold is the foundation. It's the insurance policy Frank keeps talking about. Finally, watch the DXY. If the dollar starts sliding while gold is rising, the game has changed.
Frank suggests that a weakening dollar in a time of crisis is the ultimate signal that de-dollarization is real.
So if the dollar falls, my gold goes up. At least something in my portfolio will be green.
That's the plan. Stay diversified and keep your eyes on the headlines.
Jeff Snider just dropped a bombshell. Walmart's massive quarter isn't a sign of a booming economy. It's a distress signal from the wealthy.
Exactly. Jeff Snider points out that households making over $100,000 a year are the ones driving Walmart's gains right now.
Wait, so the people making six figures are ditching high-end stores for the discount aisles?
Precisely. When the rich start hunting for bargains, it's usually because their budgets are getting squeezed by inflation and economic uncertainty.
It's the ultimate trading down effect. But wait until you hear what Jeff says about the inventory ghost haunting other retailers like Target. According to Jeff Snider's analysis, high-income shoppers now account for 75% of Walmart's recent market share gains.
That is a staggering number. It means Walmart isn't just winning on price. They're the only lifeboat left for the middle and upper middle class.
Hold on, 75%? Is that why my local Walmart feels like a luxury car dealership parking lot lately?
Literally, yes. Jeff notes that this shift shows the consumer isn't strong. They're desperate to maintain their lifestyle by cutting costs elsewhere.
So the strength everyone sees is actually just a migration from expensive stores to cheaper ones.
So we're not spending more, we're just spending smarter, because we have to.
Jeff Snider highlights a massive divide. Walmart is soaring, while Target is struggling with an 8.1% performance gap.
Target represents discretionary spending, stuff you want. Walmart represents staples, stuff you need. People are cutting the wants to afford the needs.
So the Target run is officially dead, because people can't afford the impulse buys.
That's exactly Jeff's point. Discretionary spending is hitting a wall, and that's a classic pre-recession indicator.
When the gap between need and want gets this wide, the broader economy usually follows the wants into the basement.
Great. So my lack of new throw pillows is a national economic crisis.
Jeff Snider also pointed out that while food is still expensive, general merchandise prices at Walmart are actually starting to fall.
That sounds like a win for consumers, but Jeff warns it's actually a sign of weak demand. Retailers have to cut prices just to move inventory.
Wait, falling prices are bad? I thought it was the whole goal.
In a healthy economy, yes. But here it suggests the inventory bullwhip is snapping back. Companies over-ordered and now nobody's buying.
If companies can't sell at a profit, they stop ordering, they stop producing, and then they start laying people off.
Okay, so the sale sign is actually a danger sign. Noted.
Jeff argues that consumers are now obsessed with value in a way we haven't seen since the 2008 crisis.
It's not just a phase. People are actively hunting for deals and switching to private labels to save even 5 or 10%.
I've definitely been buying the generic cereal lately. Is that what we're talking about?
Exactly. Jeff Snider says that when this behavior becomes entrenched, it means the consumer is bracing for a long-term downturn.
The psychological shift happens before the official data catches up. Jeff thinks we're already there.
So the data is basically the last person to know the party is over.
Jeff Snider predicts we're heading for a recessionary cliff once these high-income earners finish trading down and still find themselves short on cash.
Right? You can only switch from Target to Walmart once. After that, if things keep getting tighter, you just stop spending altogether. And
so Walmart is the final stop before the spending just stops?
That's the fear. Jeff believes the surge in Walmart's traffic is the final warning shot before a broader contraction.
It's like the last safe harbor in a storm. Once that's full, everyone else is out in the open.
I'm starting to think I should learn how to grow my own vegetables.
Jeff also anticipates further deflation in non-essential goods through the rest of the year as retailers struggle with excess supply.
We're talking electronics, apparel, and home goods. Jeff says to expect aggressive discounting as companies get desperate.
So wait, electronics will get cheaper? Maybe I can finally get that new TV?
You could, but Jeff Snider's point is that you'll likely be too worried about your job to want to spend the money.
It's the classic deflationary trap. Prices go down, but nobody cares because they're terrified of the future.
Well, that sucked the fun out of a new TV real fast.
Jeff Snider suggests investors keep a hawk-like eye on inventory-to-sales ratios. If they keep climbing, a price crash is coming.
If companies are sitting on piles of stuff they can't sell, their margins are going to get absolutely obliterated.
So if I see news about record inventory levels, that's my cue to be careful.
Exactly. It means the consumer has officially tapped out.
Finally, Jeff says to watch credit delinquency rates, especially among higher earners.
If people making over $100,000 start missing credit card payments, the trading down phase is over and the default phase has begun.
I thought high earners were safe. Are they really that close to the edge?
According to Jeff Snider's data, the margin for error is getting thinner every single day.
I'm going to go check my bank account and maybe hug my wallet.
Andy Schectman is back with some wild data about the silver market. He notes that China is paying a $10 premium per ounce over Western prices.
And that is not even including the 13% value-added tax. This massive arbitrage window is effectively sucking physical silver out of the West and moving it east.
So the paper price in New York is disconnected from the physical price in Shanghai. That sounds like a recipe for a supply shock.
Exactly. China is the second largest producer, but they have signaled they will hold all domestic metal for themselves.
They are basically using the lower Western paper price to hoard as much silver as possible before the system snaps. Andy's core thesis is that we are witnessing the end of paper price discovery. The real value is being set by those taking physical delivery.
He points out that the Western paper market is being exposed as a tool of misdirection, while the biggest money in the world quietly positions for a reset.
Wait, did you say silver is now a critical mineral for national security?
Yes, Andy believes the government is quietly creating a strategic silver reserve, similar to the petroleum reserve, because they realize how scarce it is becoming. The numbers from the KOMX are staggering. In February, 38,082,934 ounces left the building.
That withdrawal rate is 164% higher than what was actually required for deliveries. Someone is pulling metal out of the vaults as fast as they can.
Who has the logistics to move 38 million ounces of silver in a month?
Andy suspects it is the Exchange Stabilization Fund or other sovereign players acting under the guise of national security.
The cost to hedge silver has exploded. It went from $15,000 to almost $50,000 per contract recently.
This is flushing out small speculators and making it nearly impossible for smaller dealers to maintain inventory without massive capital.
Andy discusses a theory involving the Genius Act, where stablecoins backed by short-term treasuries generate interest that is used to buy gold.
This would create synthetic demand for the front end of the debt curve, while siphoning gold into the treasury to eventually back the back end of the market.
So instead of defaulting, they just make gold worth a lot more to balance the books.
Exactly. By letting gold go to the moon, the government can devalue the dollar and pay off debts with cheaper currency while bringing manufacturing back home. Because of high hedging costs and refineries being gummed up, Andy is making a rare offer.
He is selling 90% junk silver for 99 cents back a spot, which means below the silver price.
Below spot? Why would he do that?
It is a price anomaly. Refineries have stopped taking new silver because they cannot hedge it effectively, creating a temporary glut at the retail level. If the dollar loses its reserve status, Andy cites VanEck's projection that gold could hit $180,000 an ounce.
Even if it doesn't hit that extreme, he and Luke Roman expect it to rise into the $6,000 or $7,000 range organically very soon.
Andy's sweatshirt said it all, triple-digit silver. He believes a move to over $100 is inevitable.
With a $10 premium in China and vaults emptying in New York, $100 doesn't sound so crazy anymore.
The takeaway is simple. Stop trusting paper promises and focus on physical possession.
Use these anomalies, like the discount on junk silver, to build a position before the paper market breaks.
As Adam Taggart says, it is about being thoughtful with your money while you still have the chance.
Today, we're breaking down the latest market volatility using insights from Matt DeWolf, the head of Trade Brigade, and a seasoned technical analyst.
Matt DeWolf has been tracking the S&P 500 and the Nasdaq closely, especially during this chaotic 2026 trading environment.
Wait, Trade Brigade? So he's looking at the actual charts, not just guessing based on headlines.
Exactly. He focuses on price action and failure patterns, which is why his take on the recent gross domestic product miss is so interesting.
Matt DeWolf points out that even though the economy looks shaky with the gross domestic product miss, the charts are telling a different story.
So the news is bad, but the stocks are fine? How does that work?
That's the alpha we're getting into. Matt's analysis suggests that the failure of sellers to hold prices down is currently more powerful than government data.
We're going to dive into his key levels for the S&P 500 and why this upcoming Wednesday is a massive pivot point for the entire year.
The big shocker Matt DeWolf highlighted was the gross domestic product missing expectations while inflation remains sticky.
The PCE price index year over year came in at 2.9% versus a 2.8% consensus.
Hold on. So growth is slowing down, but prices are still up? That sounds like a disaster for the market.
On paper, yes. Plus breaking news on tariffs being bumped to 15% instead of 10% added to the volatility.
But Matt notes that despite all this, the market held up surprisingly well, proving that headlines don't always dictate the trend. Matt DeWolf is laser focused on 686 for the S&P 500.
He notes that sellers attempted to move prices lower on Tuesday and Wednesday, but completely failed to keep the close below that weekly midpoint.
So if it stays above 686, the sellers have basically lost their momentum.
That's the theme. As long as it holds, he remains neutral to cautiously bullish, regardless of the macro news.
While the S&P 500 looks resilient, the Nasdaq is a different story.
Matt points out that the QQQ is still in a downtrend with lower lows and lower highs underneath the weekly 20 SMA.
Wait, so tech is the weak link right now?
Exactly. Until it reclaims 613, Matt says it's hard to be fully bullish on the broader tech sector.
Everything else is just noise compared to what happens this Wednesday with Nvidia earnings.
Matt calls it the most important week of 2026, and it all boils down to that one report.
So if Nvidia misses, does the whole market roll over?
Likely so. Semiconductors still have the power to make or break this entire market rally.
Matt DeWolf's bull case involves a daily close above Friday's high of 689.75.
If that happens, he predicts a rotation toward the top of the expected move range at 703.11.
And that would be a new all-time high, right?
Exactly. It would prove the bulls have officially absorbed the bad macro data and taken control. On the flip side, Matt warns that if the S&P 500 fails to hold 682.35, things get ugly.
Losing that level would confirm a lower high on the daily chart and likely send us back down to test the bottom of the balance range.
So that's the trapdoor to watch out for.
That's the spot. Under that level, the bearish pressure is officially back on.
The big takeaway from Matt DeWolf: don't overtrade while we're stuck in this range.
Stay patient and wait for the Nvidia numbers after the close on Wednesday to confirm the next big trend.
So sit tight and keep the powder dry until Wednesday afternoon.
That's the plan. Preserving capital is more important than catching a random intraday move ahead of the wildcard.
Also, keep an eye on small caps. The IWM is building a constructive series of higher lows.
If it can break over 264.65, it would signal a healthy broadening of the market rally.
Small caps leading the way. I'll be watching for that breakout.
Kicking things off with Matt DeWolf, he warns we're caught in this growth inflation trap where inflation just won't quit.
Right. He emphasizes that structural issues like labor shortages and supply chain fragility keep inflation elevated.
So we're stuck? That's a bit of a bummer.
It is, especially since that means any semblance of economic stability is still up in the air. Next up, Andy Schectman focuses on precious metals, particularly how physical scarcity is misrepresented by paper prices.
Exactly. He argues that this discrepancy poses risks for investors in the long term.
Wait, does that mean if I have actual silver, I'm better positioned than someone just holding stocks?
Potentially, yes. It highlights the need for real assets in turbulent economic times. Jeff Snider brings a fascinating perspective on how high-income individuals are increasingly shopping at discount stores like Walmart.
This reflects a broader trend of affluent consumers seeking value amidst economic uncertainty.
So basically, even the wealthy are feeling the pinch. That's wild.
It underlines a significant shift in consumer behavior worth watching. Finally, Frank Giustra posits that geopolitical tensions could create a war premium, essentially hiking prices for precious metals.
He links this directly with rising global instability and increased demand in volatile markets.
So we're talking about more than just economics. Geopolitics is at play here.
Absolutely. It's a multifaceted issue impacting investments. Here's a consensus. Everyone, from Matt to Joseph, agrees that inflation is here to stay for the foreseeable future.
Right? Each guest highlights various aspects of what's causing the inflation to persist.
So we're all in agreement. My dollar isn't going to stretch like it used to.
Sadly, yes. Watching inflation will be crucial. Interesting point of agreement. Both Jeff and Andy stress that value investing is key right now.
Yes, they view precious metals as serious hedges against inflation and economic instability.
So if I want to ride this inflation wave, I should be looking at gold and silver.
Exactly. They both advocate for physical assets over paper. Also, Frank and Joseph both point out that growing geopolitical tensions will shake up markets.
Definitely. They believe this will push more investors into safe haven assets, refining the focus on gold and silver.
So a war somewhere could send my gold soaring.
In theory, yes, it's worth considering. Now we have a divergence. Matt thinks stabilization is near, but Jeff disagrees.
Right, Matt sees inflation mitigating in the short term, largely due to temporary disruptions.
So Matt is saying we can expect relief soon, while Jeff paints a gloomier picture.
Exactly. It's a gap in timelines that can affect investment strategies. Then we have Andy and Matt, who clash on what's most pressing, scarcity versus structure.
Matt emphasizes structural changes affecting inflation, while Andy thinks it's all about physical shortages.
So does that mean there's no clear answer as to which is more important?
Essentially, both aspects are critical, but warrant different strategies. And finally, Jeff and Joseph have differing views on consumer behavior.
Jeff argues consumer behavior follows market prices, while Joseph insists it drives those prices.
So we have a chicken or the egg scenario. What does that mean for forecasting?
Yes, it complicates predictions and highlights the necessity for nuanced analysis. Wow, what a journey through these insights. If you found value in this breakdown, be sure to hit that like button.
Subscribe for even more financial clarity as we sift through the best analyses in the market.
Honestly, I learned so much today. You definitely want to keep up with us.
Thanks for tuning in, and stay alert for our next video. It's going to be another deep dive into the world of finance.